And Greg, you go right ahead when you're ready, buddy.
Good morning, everybody. Appreciate that introduction. Like Coleman was saying, obviously 2020 was a year unlike any that I've ever seen in my lifetime, and things just keep changing rapidly, and it's no different in the tax world. So there has been, as Coleman said, a copious amount of tax legislation come out over the last year throughout 2020, even all the way up, through December, and in January, there's been more come through. So this tax update isn't going to be your traditional looking at the changes in the brackets. I have a few slides in there that do that, but I felt like the time might be better used just doing a real high level overview of some of the relief kind of acts that were passed and specifically looking at the provisions in those that affect businesses and small businesses, that just to make you aware of what's out there. The point of this update is to not get bogged too down into the details, but more kind of just highlight what all is out there and what's been made available and what's going to continue being available. And then at the end of the update, we are going to kind of take a look at what Joe Biden has, kind of put out there as some of his proposed tax reform legislation, and specifically looking at this most recent stimulus package that they are trying to get through the Senate and the House as we speak. So going forward, let's see, slides going. So the first act we're going to look at is called the CARES Act, and this one was passed in March 27 of 2020, and it really was a response to COVID-19, and it was a way to, the main thing that you probably will remember from it is this is where the first set of the first round of stimulus checks was in, and there was also several individual and business tax changes that were in there. This is also when they kind of added the $300 to the unemployment compensation. It was on this CARES Act that came out. So looking at the CARES Act, kind of a quick overview of it. One of the bigger provisions in there was this employee retention credit, and so this is a credit that you would claim, and the credit would be claimed on your payroll tax reports. And so basically, if you were forced to either close your operation or you were able to remain open, but for any quarter during 2020, your gross receipts were down 50% from what they were in that corresponding quarter of 2019, then you might have been eligible to take this credit. And it was basically a credit on the first $10,000 worth of wages paid to employees. And depending on the size of your business, if you were under 100 employees, you would get that credit, even if that employee was still working. If you're a business over 100 employees, then that credit only applied if you were paying your employees for not working, basically. But I'm not going to get into the math on all the credits on here because that would just take too much time. But originally, this one expired at the end of 2020. But as we'll see when we take a look at the most recent act that was passed in December, they actually extended it and made a few changes to it, and we'll get into that a little bit later in the presentation. There were some employer payroll tax payment deferrals that you may have heard about, and when I say deferral, it doesn't mean that you don't have to pay these payroll taxes, but it's basically them allowing you to defer them out of 2020 into 2021 and then pay them back at that time. We didn't really advise a lot of our clients unless they're in real desperate times to take advantage of that, just because it's just another liability hanging out there. You still are going to have to pay that back. It's just at a later date. There was some net operating loss provisions that they put in as a way to kind of help businesses help their cash flow out and immediately. And so basically what they did is they took, if you had losses in 2018, 2019, and 2020 on your return, so if your losses were more than your income, or your business losses were more than your income, you get what's called a net operating loss. And you can usually just carry that forward and you can't carry it back. But they came in and they said for 2018, 2019, and 2020, you can take that loss that you had in those years and carry it back to a prior tax return. And when you do that, you could create an additional refund and you can get the cash immediately that way. And so they put that in there. And like I mentioned, under the current law, you're only able to carry them forward. So this kind of creates a benefit for you if you're able to carry it back to NOLs, especially since you can carry it back 5 years. Some of the rates were a lot higher back in those years, not a lot, but a little bit higher in those years. So it's a pretty good thing to look at. So if you know that on any of your tax returns you had a net operating loss, if that sounds familiar to you, and you might want to talk to your CPA or whoever is doing your tax returns and ask them about this. A couple other things. The main thing on this slide I want to talk about is this qualified improvement property correction. And what this is if you've put in like you bought a building, or if you're in the business, you're renting stuff out, or even if it's your building for your business, if you put it in to service in 2018 or 2019, the rules at that time, it's basically we're having you to depreciate that over 39 years. They came and they changed that to where you can depreciate over 15 years. And because it's depreciable over 15 years, you can actually take what's called bonus depreciation. And bonus depreciation allows you to basically expense the whole thing in that first year. And so if you have a building that was put into service in 2018 or 2019 or 2020, and it's on your tax return, you should check and make sure that you are able to take bonus on that, on the improvements to that building. So this isn't for the whole building. This is if you have a building and you make improvements to it. It's called qualified improvement property. So basically, say you had your building and you are redoing a whole section of it, a room or something, and you're remodeling it. That cost of remodeling, in the old rules, you would have had to depreciate that over 39 years, which is going to just result in small deductions over a long period of time. But under the new rules, you can actually take bonus and expense that amount right away. So just make sure that if you have anything like that, if you had any major remodels or anything like that on your buildings in the last few years, that those are being handled the correct way. Charitable contributions, they made a few changes to charitable contributions and how they're handled. They're basically allowing you to do an above the line deduction. What that means is it's a deduction on your tax return that is not on Schedule A or not. So you basically can claim it even if you're not itemizing. So you could take the standard deduction and also take this deduction on top of that. And so it's a $300 deduction, but it's something that allows you to get some benefit for charitable contributions made in 2020, even if you're not itemizing. And now that they've raised the standard deduction for married couples, oops, my light just popped off. There we go. Sorry about that. Now that they raised that standard deduction up to $24,000 for married, filing joint taxpayers, it's a lot harder to itemize. So this is a way that allows people to still get some tax benefit from making charitable contributions. And so they also went on, if you're a corporation, normally you're limited to 25% of your taxable income on what you can take as a charitable contribution deduction, or 10% of your income. And now they bumped that up to 25% for 2020 and 2021. And so that's a big one. Another thing is, typically, even if you itemized your cash contributions, you were limited to basically, I think it was 60% of your income on what you could actually take as a deduction. And for 2020, they went and said there is no limit based on what your income is. You can take as big of a cash contribution deduction as you want. So I don't think a lot of people are going to run into that problem, but it's worth mentioning. The big thing that was in here in the CARES Act was the stimulus payment. And it was, $1,200 for a single taxpayer, $24 for a married filing joint return, plus 500 each for a child under the age of 17 that is a dependent. These payments were reduced or potentially fully eliminated depending on what your AGI was, which your AGI is basically your income before considering your standard deduction or your itemized deductions. And so based on your AGI for your 2018 or 2019 tax return, they're going to phase out this payment starting at $75,000 if you're single or $150,000 if you were joint. So basically, if you had a $150,000 AGI and you're married filing joint, anything over that, you started to get phased out on these payments. So taxpayers could be eligible for a tax credit against their 2020 tax liability if you were not able to get that direct payment based on your 2018 or 2019 income. So what that means is they didn't know when they sent these payments what your 2020 income was. So they were sending it based on either your 2018 or your 2019 tax return. A lot of people hadn't filed their 2019 tax return at the time that they sent these payments out. So if that was the case, it would have been based on 2018. If you had filed your 2019 tax return, it would have been based on that. So the thing about that is, say your income for 2019 was above 150,000, but for 2020 it was below it. So you wouldn't be getting a payment based on your 2019 tax return. And the way that they kind of fix that is on your 2020 tax return that you'll be filing this year, you are able to go ahead and claim a credit for that and get your payment at that time. And so there's a new line on the tax return where you're going to kind of reconcile that out. And the really good thing about it is that if it works the other way, say your 2019 tax return, you had less than $150,000 income and they gave you the full payment, and then in 2020 your income for whatever reason was way up and you shouldn't have been eligible for the credit, you do not have to pay it back. So it only works out in your favor. So that's some good news there. And this poll question number 1 is Coleman. Has this coming up?
Greg, we had a little technological snafu. We don't have any poll questions.
Okay, well then we'll skip right through that.
If you would just ask them the poll questions, we don't have an ability to record their answer, but that's totally our fault. I was waiting for this moment to explain it. Totally.
I would ask, but I don't remember exactly what they were off the top of my head, so we'll just roll through those.
The first poll question was if a business received a PPP loan.
Okay, that's right.
And I'll be ready with the other poll questions, but we don't have the little graphic for it, so totally my fault.
Okay, no, that's fine. So moving on to the next act. So we covered the CARES Act. That was back in March. There was another act, the Family First Coronavirus Response Act, that was passed in 2020 as well. I think that was closer to June or July. That had a lot of payroll kind of related credits and stuff. I didn't put that on here just for the sake of time, but it's something to be aware of that's out there. This is the one that was passed on December 27th, on December 27th of 2020. So this was called, and they called it the Consolidated Appropriations Act. And within that, there were several other acts that related to the tax bill, but I just refer to it as the CAA for the Consolidated Appropriations Act. Like I said, it's the 4th major relief legislation that they enacted. And it basically serves as a vehicle to provide, additional COVID-19 relief for businesses. And they also, within this act was also kind of a bill that they had to use to fund government operations, basically a budget for the fiscal year. So here's where I mentioned the previous relief bills, the Family First Coronavirus Response Act, CARES Act we just went through, and this PPP Flexibility and Accountability Act. This was something that was passed to kind of loosen up some of the rules on the PPP loans, which we'll talk about a little bit more in a second. So the biggest thing in the CAA was this, the highest talked about, at least in the media, was the second round of stimulus checks. So the second round is real similar to the first, just a slightly different amount. So $600 for someone who's single, $1,200 for a couple that's married filing joint, and then $600 for each qualifying child under 17. So that's a dependent. And then kind of just like the other one, these threshold amounts here for when it starts to phase out: 75,000 when you're single, 150,000 for a married filing joint company. And then as you go above that, you basically get phased out $5 for every $100 you go above it. So here's kind of a little chart that kind of shows how the payments work and how they kind of phase out. So looking at this person up here, this filer up here, that they're married and they have 2 dependents, so they're getting, the $1,200 plus the, for the 2 dependents, so they're getting $2,400 payment up to it reach 150,000. And then as their income goes up close right before 200,000, that's when they get phased out. And this kind of shows you what their payment would be over that phase out. So it's just a chart you can kind of look at this, kind of look and see what you should have gotten, compare it to what you did get, and make sure there's nothing else you need to be claiming on your 2020 tax return. So like I said, and the CAA, they kind of made some updates to the original PPP rules. And so I don't know how many of you guys actually did get the first PPP loan, but a lot of our clients, that by the time this was passed in December of 2017, they had already gotten the original PPP loan, and then also already kind of applied for the forgiveness for it. And so basically just a quick overview of what the original PPP loan was. The IRS basically came out with, using the SBA, they came out with kind of a streamlined loan process that would allow you to get a loan for about 2.5 times what your average monthly payroll was in 2019. And you could get, so you basically find out what that average monthly payroll was, and you would be able to take out a loan for 2.5 months worth of that. And then as long as you use those funds on the correct things, which was either payroll, rent, or utilities, then you would get full forgiveness for that loan after you go through the process of applying for that forgiveness, which is a lot more difficult than first expected, and it was just constantly changing, which they pushed this out as fast as they could, and because of that, there was a lot of changes they had to make, and it was a little bit of a mess, but at the same time, it's kind of understandable with the speed they were trying to go through with some of this. So that was the first loan, and so that originally ended at the end of December, end of 2020. So that was going to be gone. You weren't going to be able to sign up anymore for that first draw, the PPP loan. But when they came out with the CAA, they said that they're going to extend the application deadline for the initial PPP loan to March 31st for businesses that haven't yet taken it. And they kind of simplified it a little bit more for businesses that had loans that were $150,000 or less. So if you had a PPP loan for $150,000 or less and you haven't applied for forgiveness yet, just be aware there's a new form that's out there that's even simpler than the other ones to apply for the forgiveness. And they also added to the list of expenses that you can use with those original PPP funds. And so just something to be aware of on that part. So poll question 2, that was going to be, I do remember this one, that was going to be asked, do you plan on applying for the second round of PPP loans? And so that was another thing that was added in the CAA, was the second draw PPP loans. So this, they put this in there, and this is for businesses that already received a PPP loan, the first draw, and it's more targeted than the first one was. The first one, basically, you just had to be an employer with 500 employees or less. You could be a self-employed person, and there wasn't a requirement to show that your business was struggling, other than you signed a certification saying that you were affected by the coronavirus, or that there was some risk associated with it to you, but there wasn't like a hard number test on it. And this second draw PPP loan, there is a little bit of that. So this slide kind of shows how you qualify. So The first thing is you must have had the previous PPP and you must have used all of that original loan. The second thing is the amount of employees you have. But like I said, on the first time PPP, it was 500 employees or less. For this one, it's 300 employees or less. And here's the thing that's the main thing that makes it different on how you qualify is that to qualify for the second one, you must have suffered a drop of at least 25% in gross receipts. So this is when you're looking at 1 quarter in 2020 compared to 2019. You could also look at the whole year of 2020 compared to the whole year of 2019 is another method they had to allow you to look and see if you qualify. You had to be in operation on or before February 15th, 2020. And so eligible entities for this is, for-profit businesses, certain nonprofits, self-employed individuals, sole proprietors, agricultural cooperatives, and independent contractors. You can all qualify if they meet the other criteria. So how much could you get? It's the loan amount again is 2.5 times the average total monthly payroll. If you're in the food or lodging business, so like a hotel or a restaurant or something like that, you can actually use 3.5 times of your average total payroll, monthly payroll. And then, so this is last thing is kind of what if you returned all or part of your PPP loan in 2020? Then, there's a lot of new rules out there. And so some clients, they might have gotten a certain amount and then they just didn't have enough expenses to get the full forgiveness on it because, maybe their business had been affected to the point where they had to let people go regardless of this, and they just didn't have enough payroll to get the full forgiveness. They're actually letting you to reapply for the maximum amount of loan. If you paid it back, you can get that money back now. There's a process to do that. So another thing that was out there is this economic injury disaster loan, and this is also through the SBA. You could have gotten this loan. Originally, you weren't able to take this loan. And you got this $10,000 grant when you got this loan originally, but you weren't able to get forgiveness on the PPP loan for that $10,000 amount. It kind of worked that way, but they changed that to where they don't interact that way anymore. So basically what this is a separate loan. It's not a PPP, and you can't use the loan proceeds for the same expenses that you're using the PPP proceeds. So if you get both, you would have to have enough expenses that you could use some for the PPP and some with this economic injury disaster loan. The thing that was unique about this loan, though, is that anybody that applied for it, you were eligible for up to a $10,000 grant, and it was income tax free. And it was originally limited to $1,000 per employee, but it's not anymore. And so this is something to look into more if you're eligible for it. So I would definitely look into this. Some other loan grant updates that were in the CAA. So when they originally came out with PPP and the economic injury disaster loan, they also had a program for businesses that already had a loan taken out with the SBA. So if you had a loan taken out with the SBA under Section 7A of the Small Business Act, the SBA was actually required to pay the principal, interest, and any fees associated with that loan for 6 months. And the CAA kind of extended that provision for an additional 3 months for most businesses and additional 5 months for certain smaller, harder hit businesses. So now also they made it for even new loans that were approved from February 1st through September 30th of 2021. So if you were able to get one of these loans from that time, the SBA is going to be required to pay the principal and interest for the first 6 months on it. The payments are generally capped at $9,000 per month. And originally what they said in the rules, the IRS was saying that was going to be income, but in this act, they said these payments are going to be not going to be included in your taxable income for the year. There's also a new grant that's created. So and it's specific to live venue operators, theaters, or live performance operators. So if you have a theater or anything like that, there's a grant that's out there. You can't do the PPP loan and this grant at the same time, but if you're in one of those businesses, it's a really good grant. So it's worth finding out more about if that could possibly apply to you. The SBA also has other loan programs out there that don't have, these necessarily targeted COVID relief provisions in there, but they're still, out there, and they're easier a lot of times to get if you can't go through a bank, or if there's something holding you back on that end. Sometimes you can go through the SBA and take advantage of some other loan programs there. So some payroll tax relief that's in the CAA. There's this employee retention credit for shuttered businesses. So basically, we talked a little bit about the employee retention credit. They extended that and expanded the credit for against payroll taxes for wages paid to employees from March 12, 2020 through June 30, 2021. So the big thing about it is you used to not be able to take this credit if you had gotten the PPP loan. So a lot of our clients, they got the PPP loan, and we weren't even worried about this employee retention credit. But what they did in this act was they took out that rule that said you couldn't have both, and they made it retroactive to 2020 as well. So we have clients that weren't originally eligible for this credit that now are, and we're having to try to go find those. And so if you got a PPP loan and you never heard of this employee retention credit, it might just be because your CPA or whoever you listen to, what they knew you couldn't have both, and so they weren't worried about it. So it's something to inquire about for sure. If you got a PPP loan, and if you think your business might have suffered in 2020, in terms of gross receipts, because we kind of talked about that gross receipt requirement. So if your gross receipts went down in a quarter from 2020 when compared to 2019, you might be eligible to take this employee retention credit. Another thing you probably are aware of is there's payroll tax credits for required paid sick leave and paid family leave under the Family First Coronavirus Response Act. So what this is if you had employees that had to take time off because either they were sick or their kids' school or daycare got shut down. Basically, the DOL was in 2020 was requiring you to let employees take off for that time, and for you to still pay them through that thing, and then in turn you were getting a payroll tax credit to kind of pay you back for those wages that you were paying while the employee was out with those things. So I won't get into all the numbers of it, but basically what happened is, that requirement to do this from the DOL ended at the end of 2020. So you're no longer required to do it, but if you voluntarily do it, the credit is still available out there. So in 2020, there was a requirement to do it and a credit, but in 2021, you're no longer required to do it. But if you do, you still are eligible for those credits. Let's see, I'm trying to. So a delay of payment of the employer portion of Social Security payroll taxes. So in the CARES Act, they provided that, certain businesses and self-employed individuals, you might be able to defer paying your employer share of the Social Security tax for 2020. And so now, 2021, half of that deferred amount must be paid by December 31st, 2021, and the second half by December 31st, 2022. So if you did that deferral, that's just kind of showing you when you have to pay those amounts back. There's, also, you probably saw this in the news, Trump signed an executive order kind of saying for this employee portion of Social Security payroll taxes, businesses were able to defer paying that as well in 2020. This is the thing I was talking about that we really kind of discouraged people doing, unless it was, their employees were really pushing them to do it, or they just were in real need cash flow wise, because really it's confusing for your employees. You're basically increasing their checks for a little bit by not taking out the Social Security tax, and then when it comes 2021, they're gonna have to start paying that part back. So now their checks are gonna be lower for a while, And it just creates confusion because a lot of people were thinking, they just didn't have to pay that at all, but really it was just a deferral to the next year. And it's kind of an administrative hassle just for a short-term deferral there. So here's some other tax revisions from the CAA. This is a big one. So business meals that you get from a restaurant are going to be 100% deductible, and it says for 2021 and 2022. Oh yeah, I mentioned it. So for 2021 and 2022. So rather than 50%. So right now, so any business meals you're doing from a restaurant, and this doesn't mean you have to be at the restaurant. You can buy it from a restaurant and get it, delivered to your business and or delivered somewhere. And as long as it meets the other requirements that you normally had to meet for a business meal to be deductibles, meaning, it is an actual business meal. It's not just, your personal time, eating or whatever, but you're actually able to deduct 100% of it when in the past you were only to deduct 50%. So that's one that people definitely need to be aware of. So the above the line, we kind of talked about that new charitable contribution deduction that you can take even if you are doing the standard deduction. This act basically made that available in 2021 as well. And for 2021, that deduction is going to be $600 instead of up to $600 instead of up to $300. We mentioned this about the AGI threshold for charitable contributions. So it is increased from 60% to 100%. They extended that through 2021 in this act. So, and here's another kind of interesting one. Before all this was going on, if you had a flexible spending account, which other people kind of sometimes hear a cafeteria plan for healthcare costs or dependent care costs, used to the rules were that you would at the beginning of the year kind of decide how much you wanted to take out for your flexible spending amount for healthcare, dependent care, and if you weren't able to actually use that amount throughout the year, you kind of just lost that. And so, but what they've done is, since they know a lot of people weren't able to get access to healthcare, or they didn't have to pay as much dependent care because they were shut down. They're allowing people to roll in the unused amounts from 2020 to 2021, and then also from 2021 to 2022. So if you had, if you said you had $5,000 for dependent care in 2020, but you were only able to use $3,500 in the past, you kind of would have been out that extra $1,500 that they've been taking out of your check all year. But now you can actually roll that forward and use it the following year. There's a new program that they came out with. So where it allows you to, for your employees, to make student loan payments on behalf of them up to $5,250, and you can actually exclude that from their income. So it's a new kind of way, a new benefit that's out there. And this is as long as the payment's made after March 27, 2020 and before January 1st, 2026. So that January 1st, 2026 is where this is set to expire if they don't extend it. So really, this is just something that's out there, a new type of benefit that you can offer some of your younger employees that are really maybe not necessarily that younger employees that still have student loan payments they're doing. You could offer a benefit to pay some of those on their behalf, and they can actually exclude that amount from their income up to $5,250. The thing to know about this is you can't pick and choose who you're going to do that for. So if you're going to do that for some of your employees, it has to be that same plan that you're extending has to be available to all of your employees. That covers that this Consolidated Appropriations Act. Those are some of the biggest things that are out there. Like I said, I didn't want to go too far into the weeds on those things because we had so much to cover, but I wanted to just let you guys know what is out there. And if you have questions, like my emails on these sides, you can always email me, or go see if you have a CPA, you go ask them about some of these things, and just make sure that they're that you're taking full advantage of all these things that are out there right now. I wanted to go through real quick and just kind of look at some of the brackets for 2020. Just feel like it wouldn't be a tax update without looking at a bunch of numbers of the brackets. But here's the individual tax brackets and rates for 2020. So your 10% bracket is up to, we'll look at married, filing, joint. 10% up to 19,750. Then you start your 12% bracket for amounts of income that are above that. Then you go up to 22% at 80,250, 24%, all the way down through to 37%, starting at 622,000 of income. So once you start making over that, everything is starting to be taxed at 37%. And here we'll see 2021. So you'll see everything on 2021 is just bumped up a little bit for inflation. There's no changes coming that we know of right now. The next thing we're going to get into is some of Biden's proposed stuff that will likely change a little bit of this. But for 2021, this is what is scheduled for the brackets to look like. And it's really just adjusted for inflation. There's some changes to key tax figures from 2019 through 2021. So your standard deduction for 2020, which is the tax return that people are working on right now, 12,400 for individuals, 24,800 for married filing joint. In 2021, that's going to go up about $150 for individuals and about $300 for married filing joint. Here's the maximum elective deferral to retirement plans, like a 401k plan. So 2020, 19,500. 2021, it's going to be 19,900. This is your limits on annual additions to some retirement plans, to the defined contribution plans. 57, this is things like a SEP or and things like that. So 57,000 for 2020, 58,000 2021. Hsa contribution limits, 3,550 for individuals, 7,100 for a family for 2020. It's going to go up just a little bit in 2021. And here's a big one, and we'll kind of talk about this a little bit when we're looking at some of Biden's, the things he's put out there as proposed tax reform. Currently in 2020, the estate tax exclusion, which this is basically the amount that you can either give or you can gift over your lifetime, or after you pass away, you're allowed to transfer over to your descendants tax-free. So anything over this 11,580,000 that you either gift or transfer at your death, you're going to be taxed on. So you're basically allowed to give away that much throughout your lifetime without tax. And that amount fluctuates. That it's in the past, it's been about 5 or 6 million. And then when Trump passed, the Tax Cuts and Jobs Act, that's when it got bumped all the way up to this 11,500,000 number. And there's a lot of speculation about if a new tax reform plan is passed by the Biden administration, that it will probably go way down. So there's a lot of people doing some estate planning now based on that, and we'll talk about that here in just a moment. Poll question number 3. I do not remember that one, Coleman. If you want to ask that one.
I got it right here.
All right.
I got it right here, Alex, because I am super prepared. So, yeah, again, our fault for not being able to do the poll questions. We completely botched it. So, poll question 3, it's something for you to think about. Given results of the most recent election, do you expect any major tax reform legislation to get passed? And that's probably a question not just for people watching, but also for you, just as somebody who has seen a couple of different administrations come through. That's a question I think that's universal. Do you expect any major tax reform legislation to get passed?
And the answer is yes. Most likely we will see something get passed. I don't know how major it will be, but we are going to see some things get passed. Now, there's a couple of different things we're going to look at. First, we're going to look at this, what's been in the news lately has been this new stimulus bill. So this new recovery bill, which, you've probably seen, it's 1.9 trillion number out there about what this is what it could cost. This isn't the tax reform bill that Biden has talked about before. We'll talk about that afterwards, but this is more targeted at, more relief. So basically the newest version of, the plans that we looked at earlier in the presentation. The biggest thing, couple of things that were in it initially, it had another stimulus payment because, originally the Democrats wanted the second stimulus payment to be $2,000, but it ended up being $600 for an individual. And so what they're wanting to do on this is get that difference of $1,400 and send that out as the stimulus payment. That is still in there. The other big thing that was originally in the bill is, raising the minimum wage up to $15 per hour. But the most recent thing that I saw that I've read about this a couple of days ago, when it was going through the Senate and they were going through the budget reconciliation process, they have kind of taken that out of there for now, the $15 per hour minimum wage, as a way to kind of better ensure that they're going to be able to get this thing through. The thing to know about them being able to get this through is they are able to use that budget reconciliation process. And what that means is that in the Senate, they don't have to have the 60 votes to get it through. They can just get 50 votes, which there's 50 Democrats, and then it'll be a tie, 50-50. And then the tiebreak vote goes to Kamala Harris. And so, that will obviously swing in the way of the Democrats. So if they have to, they're going to pass it using that. So they already kind of went through that budget reconciliation process and passed that part in the Senate. So now it goes to the House. They renegotiate some of the stuff, goes back to the Senate. Anyways, long story short is that most likely this thing is going to get passed, but what's all in it is really going to be the question. I'm going to kind of go through what, the biggest things that are mentioned in there and what still was in there in the most recent thing that we've seen. So some highlights of the plan include, like I mentioned, a $1,400 direct stimulus payments to individuals. So that would be, $2,800 for married, filing joint. This a little bit different. Dependents age 17 and over will now qualify, when before the dependents that you would qualify for additional payments for had to be 17 years or younger. They are talking about doing, we talked just real briefly about the paid sick leave and the paid family leave credits that were out there. They were talking about in this bill, extending those credits through the end of September. They're talking about adding a refundable child and dependent care credit. So basically, it would be a credit for, your costs for child care or dependent care, and it would be up to $3,000. And when they say refundable, they were actually, and talking about making it an advanced refundable credit, meaning that, throughout the year, based on your prior year tax return, you would be getting, maybe $300 a month or something along those lines. And depending on how much they end up saying the credit is going to be. And then at the next year, when you do your tax return, you will see, based on your income and everything, what your credit should have been, and you might have to pay back some part of it. So it's kind of, I don't know if any of you are familiar with the premium tax credit for if you get your health insurance through the government marketplace and you get help with some of your premiums up front. And then when you go and do your tax return, you find out what amount of help you should have been getting on your premiums. And then if there's a difference, you have to pay it back. It'll work a lot like that if it's passed as it's currently written in there. There'll be an expanded earned income tax credit that just makes it a little bit of a higher credit amount and a little bit easier to qualify for it. And then there'll be an increased premium tax credit that I was just talking about, which is that credit that's out there if you're getting health insurance through the government marketplace. They're going to increase that credit and to kind of help lower some health insurance premiums in there. So details on this next round of stimulus are likely to change as the discussions progress, obviously. this line was written kind of before the most recent updates. Originally, they were trying to negotiate a bill, like, with the Republicans on a bipartisan effort, but they weren't, the stimulus payments, they weren't going to, go for the $1,400 amount. So that's when they decided to go ahead and do the budget reconciliation process that kind of was just Democrats only voting for it in the Senate. So that is the stimulus bill that's out there. Those are the biggest tax things that are in there. This next slide is more about the tax reform plan that Biden he put it out there during the election. There's him, and it's not just his, but some other senators and other lawmakers kind of put down this proposed tax reform plan, and people pulled out a lot of the biggest provisions from it, just as a kind of a guide to look at when they're doing some planning into the future. And so I think it's important to look at. It's important to know that none of this is set in stone. This is all, what Biden has proposed. What actually ends up getting passed, or when it gets passed, no, it's hard to say. I think, they're more focused on this stimulus bill right now. And then I think after that, they're going to focus on the minimum wage issue. And then I think after that, depending on how things are going, that's when they might start getting more focused on this tax reform thing. So I'm thinking we're looking more in 2022 when something might get passed, but that's pure, that's speculation. But I would think at least then when they start looking at a major tax reform bill. So some of the big highlights of what he had proposed was, bringing that ordinary income, that top tax rate back up to 39.6, which is where it was before Trump's tax plan was passed. He wants to add an additional 12.4% Social Security tax on employees that on their income over $400,000. He wants to bring the capital gains rate, which is currently, 15% or 20% based on whatever, depending on what your income is. It would be 20% for someone that's making greater than 1 million, which is what they're talking about here. He would take that rate for people that are making over 1 million and bump the capital gain rate up to 39.6. So basically the same as what their ordinary income rate would be. He wants to get rid of the 20% QBI deduction on business income if you have income over $400,000. He wants to reinstate the P's limitation. And what this is basically if you're itemizing, it reduces your overall itemized deduction. Once your income starts to exceed $400,000, it just kind of phases it out. So you could have $200,000 of charitable contributions and you're itemizing about that amount. But if your income was $400,000 or above, you might not get any of that benefit. It would phase out over a certain income range. He wants to cap the total benefit of itemized deductions at a rate of 28%. So no matter what your itemized deduction was, he wouldn't let you get a deduction more than 28% of your income for it, is what that is saying. Let's see. He's talking about instead of getting a deduction or exemption from income for your 401k, so basically it would generate a refundable credit. So it wouldn't be a deduction; it would be a credit, and then it would be if you can. So for an example is whether you're making $30,000 or $300,000. Say you contributed $1,000 to a 401k. You would be getting a $260 refundable credit. So it's a 26% credit rather than just a dollar for dollar deduction. So it's a little bit different. If you say your top tax rate was 37% and you got $1,000 deduction, you're basically getting a 37% tax benefit. So in this case, instead of getting that 37% tax benefit, you'd be capped at 26% benefit. You want to expand the earned income tax credit even more, strengthen that child tax credit. I kind of talked a little bit about that already. They're talking about doing up to an $8,000 credit for low and middle class families. And right now it's currently $3,000 credit. There'd be a new first-time home buyer tax credit that he's mentioned, up to $15,000. It'd be advanceable, so like at the time you're purchasing it, you would get that credit. And then when you file your return, you would kind of reconcile that out. Big one, change to the estate tax. They would, you know, right now as it is, when you pass away, your heirs get a step up in basis. So say you had a piece of land that was worth $10,000, but when you died, you bought it for $10,000, but you died and it was worth $50,000. Currently, your heir gets to step that up, and so in their hands, they have a basis of $50,000. So if they were to sell it for 60, they would only have to pay a gain of 10, rather than paying a gain of 50 if they were having to take that $10,000 basis. So we're talking about getting rid of that provision and then bringing that estate tax exemption all the way down from 11.5 million to 3.5 million. So a lot of people are doing a lot of estate tax planning right now to take advantage of that $11.5 million exemption before it potentially goes down to 3.5 million. So that's something I want to mention. Talking about increasing the corporate rate to 28% and creating a corporate minimum tax on your book income. So basically what this will do is it would look at whatever your tax was supposed to be based on your tax return and compare that to looking at about what tax would be if you took 15% of your financial statement income in excess of 100 million. This will only affect really big corporations, so it's nothing to really spend too much time on. That's all for my presentation. Tried to go a little bit fast to get through all of it. Here's some of my information. There's my email. If you guys have any questions that we can't get to here in a second, which I see we're getting pretty close to the time, so I'm not sure how much time we'll have for the questions, but there's my email. If you do have one that you want to send me directly, I'd be happy to answer it. Anything that you have related to this presentation.
I love the disclaimer at the end. It's for educational purposes.
Yes. Got it.
Sure, there's a legalese reason for that. Folks, we've got a couple minutes here if you're willing to stay. If you have any questions, excuse me, if you have any questions, go ahead and put them in the chat box right now. We'll be monitoring the chat as well as the Q&A. A couple of reminders for you. We will be sending out an email to everybody who registered. It will have this presentation in it in its entirety. And we will also be sending the PowerPoint as well. There'll be a downloadable link, to get the presentation as well. So if you wanted to look back, look at some of the numbers, maybe present it to your CPA and say, are we taking full advantage of it? I swallowed my Taco Bell a little oddly. So you can take this information to go to your CPA and say, hey, are we taking advantage of this or not? The thing I took out of it is that we need to have more business meals, because now they are 100% deductible, it sounds like. So let me check the check. The check. Oh man, I'm telling you, I eat it bad. Let me check the chat one more time. Check the Q&A. Folks, we appreciate you joining us. Thank you, Greg. I'm sorry.
You're good.
Ow. Holy cow. This stuff is the worst. Ugh. The Diablo sauce. Folks, we appreciate you. Thank you for being with us. Again, we will have a recording up. Greg, as always, we appreciate you and the folks over at Gollob Morgan Peddy. Email him. It will be on the slides. Thank you, everybody. We will see you on March 15 for our next webinar, which is the 2021 labor law update. Let me check one more time for any Q&A. It's like we're good. I think that's a lot. People are trying to digest what's going on. Hopefully they take some of it. Folks, we appreciate you. And Miss Tammy, whenever you're ready, you can go ahead and end the webinar and we will in good shape. Greg, we appreciate you, buddy.
All right. Thank y'all.
You bet.